Time for hot picks. We're focusing on the transport sector. UPS has been hit hard by tariffs, but our guest has it as a top pick. He says he's encouraged by margin improvement as UPS works to make its operations more efficient. We're joined by Ari Rosa, analyst at Citi. Ari, great to see you. Thanks very much indeed. Give us your thesis on United Parcel Service, please.
Yes, thank you for inviting me on. It's interesting. UPS has been out of favor all year. In fact, more than all year. It's been out of favor for a couple of years now. And frankly, the stock is down a lot. And we see this really as a value play. And so they reported earnings this week. It was better than expected. They're really getting more aggressive in terms of cost-cutting actions. And I think that's really where our confidence comes from. And so this is a stock that now has one of the highest dividend yields in the S&P 500. So any income-oriented investors should like this thing. They clearly are indicating that free cash flow is expected to be better over the next year. And so there's really not a lot of downside risk here and quite a lot of upside if they can engage in some of these cost-cutting programs, or if they can gain some traction with some of this cost-cutting. And then there's further upside, of course, on a macro inflection. And the economy has been weak, but we see some reasons for optimism in the year ahead.
That's interesting. The yield now gone to about 6.9%. And I know these things are very hard to predict. Is there any risk they might cut it?
Yeah, so that was actually the question that I asked management on the earnings call. It was really targeted at their free cash flow. And what they said is they're expecting a step up in free cash flow. I think what got a lot of people nervous was last quarter because of some of the tariff disruptions. Their free cash flow got hit kind of hard, and there did start to creep in some of these questions about the sustainability of the dividend. But I think they did a lot this quarter to assuage some of these fears. They also guided to next quarter having strong free cash flow. So we're looking at a better trajectory there. And I think as they deliver on a couple of these quarters here, that should put some of those fears to rest. So we feel good about the dividend. We think it's fairly, not only fairly safe, quite very safe.
Union Pacific, you like the look of this one. Tell us why.
Yeah, so Union Pacific, it's a complicated story, right? Because they're in the process of trying to create this transcontinental railroad. They've proposed a merger with Norfolk Southern, which is one of the two big Eastern railroads. And, it's going to be a lengthy regulatory process. But what we like about Union Pacific is, frankly, the stock is not particularly expensive. This is a very high quality business. So it's not, look, longer term, I think there's probably, longer term is attractive upside, and a lot of that is contingent on the merger going through. But in the near term, kind of similar to UPS, this is a stock that's been a little bit beaten up, has not really participated in the broader market rally, and it now offers some of its cheapest valuation metrics that it has in years. And so for people who are looking for a high quality business that frankly doesn't have as many kind of disruptive impacts, this is a really nice option.
Yeah. Do you think America will allow another big rail merger, or would there just be too much political pushback?
That is the $100 million question. And so that's what everyone's trying to figure out. Look, there are powerful arguments on both sides, is the reality. And it's interesting because we heard from Canadian Pacific yesterday, and we heard from Canadian National this morning. Both of them have been pretty vociferously opposed to the rail merger. Of course, they would be, right? Because it poses risk or threatens to upset kind of the balance of the competitive balance in the North American rail network. And yet, President Trump has expressed support for the idea. There are a lot of efficiency benefits, or at least potential efficiency benefits. Obviously, remains to be seen, but there are a lot of folks who seem to be confident that there can be some efficiency gains delivered by a transcontinental merger. So, we've said it's better than a 50-50 chance. The real question is, what are the regulatory constraints that are imposed on the merger, and are those sufficient to kind of sustain the competitive balance between the railroads?
And finally, give us your thesis on Knight-Swift Transportation, KNX.
So Knight-Swift is one of the largest trucking companies in North America. It's also been out of favor, much like all of transports. But a lot of these asset-based carriers, which have really been struggling under the pressure of excess supply, excess capacity, they're starting to see some tailwinds from some government enforcement actions focused at bringing, effectively what the government has done is try to crack down on issuance of commercial driver's license to non-domiciled individuals. And so that looks like it's going to have the effect of tightening capacity. And then what you've also seen is Class 8 net truck orders. So those are the big trucks that you see on the highway. Those have started to come down quite a lot. And usually that precedes an uptick in freight rates. And so that actually sets up Knight-Swift for a really positive 2026 and 2027. Not to say we're totally out of the woods here yet, but the stock, similar to UPS, similar to Union Pacific, has been pretty beaten up. And so we see really here a value play.
Before we let you go, Ari, we've only a few seconds. CN Rail, what were your thoughts on those numbers, please?
Yeah, so CN clearly executing well. I think CN has probably been one of the more hated names in our coverage. And they came out this morning and really acknowledged that, look, the volume environment hasn't been as supportive as what they expected it to be. And so they're responding by cutting costs and focusing more on shareholder returns. So what did they do? They initiated or they upped their buyback. They said they're going to be cutting capital expenditures. And so that should support free cash flow. So you're getting a nice reaction in the stock today, and we think there's room for that to continue.
Thank you very much, Ari. Really appreciate it.
Thank you.
Ari Rosa, analyst at Citi.